Okay, so welcome back to the screen. We're going to get stuck in now to video number 12, our next leading indicator. Leading indicator number 8, cyclical commodity prices. And let's have a look at what we've covered so far. We've covered a lot of leading indicators now. You can see we're accumulating throughout the video series, the first part of the PTM, accumulating multiple leading indicators. We've covered the money markets and we've covered surveys. And now we're going to be adding in cyclical commodity prices. And we're going to be covering oil, copper, lumber, and iron ore. And we're also going to be covering currencies. So we're going to be looking specifically at the US dollar trade-weighted indices. But before we get into that, we need to do a bit of background work and a bit of information on inflation. Why? Because if we're going to understand cyclical commodity prices and US dollar trade-weighted indices, it's important to understand what inflation is, how inflation works, and really how it fits into our overall framework. Now, having a low and stable rate of inflation in an economy is an essential part of a healthy capitalist system. What we need is a stable and predictable rate of price inflation of goods and services. And what this does is it provides a foundation that enables a stable rate of real GDP growth and employment. So the ideal situation, let's cover that first. What we want in a healthy economy is a good level of nominal GDP growth and a stable, positive rate of inflation that's lower than the rate of nominal GDP growth. And that gives us positive real GDP and a predictable rate of GDP. So this is considered to be an ideal situation in the economy. Really, it's what the Fed is looking for with their dual mandate, strong levels of employment. But, we can also have other situations occurring at any one moment in time. We can have the non-ideal situation, which is bad, okay? We can also have high levels of positive price changes, so we're getting inflation, or negative price changes, where we're getting price deflation, and we can have inflation volatility. Conditions like this are considered to be not ideal or even bad. And what we can do is we can analyze historical inflation data, and we can observe what are considered to be normal, so ideal inflationary conditions, and abnormal, so non-ideal inflationary or even deflationary conditions. And we can look at the data set and we can see big positive and negative changes in price inflation, so moves away from normal conditions. And what we find is that these abnormal conditions are in the significant minority. Now, how is inflation measured and presented? Well, we're going to be looking at a few measures here, just for some background information, so you understand this better. We're going to be looking at CPI, the Consumer Price Index, and the PPI, which is the Producer Price Index. So let's start with CPI. The CPI stats are split into two different measures. One is including food and energy, and one is excluding food and energy. And the data is released monthly from the Bureau of Labor Statistics. And the link is on the screen there, where you can get the monthly news release. Now, the data for CPI can be downloaded at the second link on the screen, and it goes back as far as 1947. And it's constructed by taking the weighted averages of prices on a wide variety of items, which are basically assigned weights representing their importance within certain groups. And the prices are collected on a monthly basis from 4,000 housing units and around 26,000 retail establishments across cities, across 87 urban areas of the United States. Now, this is obviously a large data set, so it's a significant number. And of course, there's a lot of importance placed on inflation by the Federal Reserve in its dual mandate to maintain a certain level of inflation and a target employment. Now, this data set, obviously, it's a big one. And this is because this is for the CPI all items measure. Okay, so 4,000 housing units and 26,000 retail establishments across the 87 urban areas of the US. But it's very important to remember, guys, that CPI and inflation data in the US is a coincident indicator. It's telling us what is happening in the economy now rather than in the future. So it's not as useful as leading indicators because the CPI follows our leading indicators. By definition, inflation data is telling us what happened to prices in the previous month. However, it is useful to us. We do need to know, obviously, the level of inflation in the economy. It's still useful as a confirmation indicator because the Fed can be obviously reactionary, and therefore interest rate policy based on inflation expectations can obviously be affected. But always remember that it's a coincident indicator. So we use it as traders and portfolio managers as a confirmation indicator to essentially confirm what we were seeing in the leading indicators in previous months. So this is the all items number. So this is including food and energy. So links on the screen there. Data is very easy to get. You just hit the download button at the St. Louis Fed link and the data drops into a spreadsheet. Next up, the CPI X food and energy. There's another link there for St. Louis Fed. You can download the data there, and the data goes back as far as 1957. It's calculated in the same way as the all items number. However, the goods included do not include any food items and items that are linked to the price of energy, including oil. Now, the CPI X food and energy number is sometimes referred to in the market as the core CPI number because it measures core inflation in the US without having the exposure to international food and energy prices that can essentially be volatile and subject to exogenous influences in the global marketplace that are outside of the control of the central authorities in the US. Now, again, CPI X food and energy, it's taken from the same data set, reported monthly and backwards looking. So it's again a coincident indicator. So we can use it again as a confirmation indicator because the Fed, of course, is not always predicting what's going to happen and trying to prevent what's going to happen. The Fed can also be reactionary. And it's just knowledge that we must have. We need to know at any one moment in time, as traders and PMs, what is actually happening with inflation in the economy. So that's how inflation is measured in the US for consumers. All items, including food and energy, and X food and energy. So the CPI all items and the CPI X food and energy. What about businesses? Well, we have a measure for inflation for businesses as well. This is called the Producer Price Index, so the PPI. And the data for PPI, all commodities, can be downloaded again following that link at the St. Louis Fed. The data goes back as far as 1913 and it's indexed to 100 in 1982. And the data is different from the consumer data, the CPI, because it measures input costs or prices for businesses that make products and provide services, whereas the CPI only measures prices that are facing consumers. Now, the way the BLS puts the all commodities index together, basically price change data is indexed for the commodities, indexed and analyzed for a whole bunch of commodities and input prices across a whole bunch of industries. And this makes up the overall all commodities index. And the list of those industries, and there's an index for each one. So the list of the industries and those indices can be found at the St. Louis Fed link on the screen. And all of these commodities that are indexed basically make up the all commodities index. Now, the PPI, all commodities index, is again a coincident indicator, but it is, of course, useful to us still as traders and PMs as a confirmation indicator, because again, the Fed can be reactionary instead of possibly being preventative. Now, our three inflation measures, so our monthly CPI all items, our monthly CPI X food and energy, and our PPI all commodities index, so released on a monthly basis as well. These are our three inflation measures. We can obviously get the data from the St. Louis Fed website, and we can do a statistical analysis of it. And what we do is we do a distribution of returns analysis on the inflation data itself. And the reason we do this is because what we want to understand is what is happening with inflation at any one moment in time in the economy. So what we have to do is look to the historical data and understand inflation and what it actually means when it moves. So as a student of the financial markets, as a student of macroeconomics, what you need to do is have a look at the data sets and understand the moves in inflation and what it actually means. So basically in the future, you'll understand the context of any inflation data when it comes out and be able to understand it better because you'll have it in a historical context. Now, the way in which we analyze the inflation stats is very similar to the way in which we analyzed the M2 money supply data earlier in the PTM video series and the various tradable instruments in the IPLT video series. We basically use the same method. So we calculate a distribution of returns to discover what is a normal level of inflation and what is an abnormal level of inflation in order to assess future monthly moves. So we understand the historical context of any move that we analyze in the future. So we take the monthly index levels that are reported by the BLS throughout history, and we work out percentage changes on a month-by-month basis. And then we run a statistical distribution analysis. So in the future, when we analyze any inflation data releases, we can distinguish between what is considered to be a normal move and what is considered to be an abnormal move for inflation. Now, you know how to do this method. You know how to use the method to analyze data. So if you have a self-starter mentality, which I hope you do, in your own time, you can use the same approach that we utilized with the M2 money supply in the PTM video series and those tradable instruments in the IPLT video series and determine both normal, so within one standard deviation, and abnormal, so outside 1 standard deviation, or even 2 and 3 standard deviation moves in consumer and producer prices. Now, it's always obviously good to know the level of inflation in the economy, but as traders and PMs, we'd rather want to predict inflation rather than react to it. So we've got to remember that the CPI and the PPI are coincident indicators and not leading indicators. Commodities prices themselves lead the commodities price indices. So each month, by the time you analyze the monthly indices for our 3 inflation numbers, the CPI all items, the CPI X food and energy, and the PPI all commodities, really, there should be no surprises, because for the previous month, you will have been on top of all the major commodity price moves, and they occur in real time in financial markets. Now, if you're sitting there thinking to yourself, Anton, this is all great, about inflation, etc., but I really can't be bothered downloading all the data and doing all of the work to figure out what is a normal and abnormal move for all 3 of these inflation indices. Well, if you're thinking that, unfortunately, you're defaulting to a position of not being a self-starter. But seeing as though it's early days in the educational process, we do have a downloads area and we've done the work for you. But I would encourage you to go into the inflation, CPI and PPI file and go through the formulas and work out how the data is all set out, and work out from the formulas how the sheet actually works. And you'll see the method is exactly the same as when we looked at M2 money supply, and when we looked at, in the IPLT video series, the various tradable instruments across asset classes. So what you should be doing first is obviously downloading the inflation, CPI and PPI file, looking at how it's all worked out, and then actually running through the process yourself and just practicing. So in the same way that you practice the method with the M2 money supply data and tradable asset data, you need to do this with inflation data as well. Now, we also have some other downloads. So there's multiple downloads for this video. We have our cyclical commodity prices. We have our commitment of traders reports for metals and energy. We also have our US dollar trade weighted index analysis. And we also have a summary file. And by the way, all the data sources are included in the files. So for example, the links that were on the screen earlier for inflation, they're all included in the file, and you can just easily click on them. But let's start with cyclical commodity prices. In the downloads area, in the sheet for cyclical commodity prices, you're going to notice that we've covered a whole bunch of them. So we've got oil, copper, lumber, and iron ore. So in oil, we're covering WTI and Brent and the WTI Brent spread. For copper, there's multiple contracts that trade globally, and we've covered them all in the downloads area. So there's copper that's traded on COMEX, copper that's traded on the London Metal Exchange, copper that's traded on the Shanghai Futures Exchange, and then we're looking at various spreads. We're looking at the COMEX LME spread and the LME Shanghai spread. For lumber, we're looking at the most popular contract, the random length lumber contract, which is on the CME. And for iron ore, we're looking at 2 contracts in the downloads. We're looking at the iron ore contract on CME and the iron ore contract in China on the Dalian Commodities Exchange, the DCE. Now, what you will notice when you look at each of these cyclical commodities, you'll notice that we've downloaded all the price data for each of those cyclical commodities. And in the same way, they're using the same method that we use for the inflation data and the M2 money supply data and all the other tradable instruments that we looked at in the IPLT video series. We've conducted a distribution of returns statistical analysis on the cyclical commodity prices, and we've done that to ascertain what is a normal, so within one standard deviation move, and abnormal, so outside a one standard deviation move, and looking at also 2 standard deviation and 3 standard deviation moves for each of those cyclical commodities on both a daily and weekly time horizon. Now, additionally, in the downloads area, you'll notice a file called the summary file. And this summary file puts all in one sheet the analysis of the standard deviation moves in all of the instruments that we're going to be looking at, from -3 standard deviation move to +3 standard deviation move for basically all the tradable instruments in our cyclical commodity space. Now, why do we do this? Why do we go through this exercise? Why is it actually important? Well, cyclical commodities often move with the business cycle, so with economic growth. The clue's in the name, cyclicality. They move with the business cycle. So if you think back to our other business cycle indicators, so the ISM manufacturing, ISM non-manufacturing, the University of Michigan Consumer Sentiment Index, building permits, and the NFIB Small Business Optimism Index. If you think of all of those business cycle indicators that are leading indicators, cyclical commodities essentially move with them. They move and tend to lead as a gauge to the business cycle. The cyclical commodity prices themselves are indicative of future CPI and PPI levels, which are reported monthly, and future economic growth, so real GDP reported quarterly, so expansion and contraction in the economy. And of course, both real GDP and inflation are reported after the fact. Cyclical commodity prices are open quotes leading close quotes because they are trading and moving every day. And then inflation is reported monthly, and then economic growth, real GDP, is reported quarterly, and they are both reported after the fact. So let's think of an example here. So a leading indicator like the ISM manufacturing number may tell us at one point in time as traders that there is a turning point occurring in purchasing manager expectations for the future. So what would that look like? Well, they may be reporting new orders growth after a contraction, or growth is accelerating. So there could be a turning point or a trend. And this can be combined with, for example, growth in inventory stocking and increases. They're reporting increases in key input commodity prices to the manufacturing process. So what does that mean? Well, it means we're getting higher commodity prices, and we have to assume here, as in the example, that we have a constant supply of the commodity. So supply is not moving. So we're concentrating on demand here. So it means that there's higher commodity prices given a constant supply in real time, because businesses are buying more input commodities, and this feeds into the inflation statistics later when they're reported on a monthly basis, and prices, by the time inflation is reported, have already moved. So what we need to understand with cyclical commodities is what is a normal and abnormal move, and use cyclical commodity prices as a gauge to shifts in inflation expectations. Now think in the bigger picture what we're trying to achieve here as traders and PMs. From a macro perspective, we are always trying to gauge which way the wind is blowing to enable a prediction of real GDP growth and likely S&P 500 direction and returns, and of course, potential Fed policy. Why do we do this? Well, throughout the PTM video series, it's been clear. We do this so we can position ourselves with the right directional bias. So a portfolio of a net long, net short, or neutral positioning, and of course, with the right longs and shorts in the portfolio. So this is how we use them as traders and portfolio managers, how we use cyclical commodities to make a more intelligent decision around portfolio bias and potentially what we want to be long and short in a portfolio. So we have to keep an eye on commodity prices and inflation expectations and understand them and interpret them and what it all means at any one moment in time. Now, we have to think about something else as well. For commodities themselves, there are inventory dynamics, which has supply side dynamics that we have to understand. So there is a supply side caveat here with cyclical commodities. So for commodities themselves, as inventories are rising, this indicates a rise in demand. So business or purchasing managers are increasing demand and increasing their own inventories. And we know that's a bullish indication. On the flip side, if inventories are falling, this indicates a fall in demand. So business and purchasing managers are reducing their demand and reducing their own inventories. And they're consciously doing this for both cases. So rising inventories is indicating a rise in demand from purchasing managers, and that would be indicating bullish conditions. And inventories falling, that's indicating a fall in demand from purchasing managers, and that is indicating, obviously, bearish conditions. So for these cyclical commodities in the energy and industrial metals space, within these companies, there are internally traders of energy and industrial metals commodities, and they are increasing or decreasing their stocking levels in accordance with actual and expected demand. So, given a constant supply, prices that are increasing and decreasing are a gauge on business or purchasing managers' actual and expectation of demand. But there is a caveat to all of this. Prices are, of course, a function of both demand and supply dynamics. So it's not an automatic function that prices must follow expected demand. Of course, there can also be cost push or supply factors that we have to consider as to why prices are where they are at any one time. And we'll come to this in a moment. We have a PDF download to help with this. But, however, we must always be on top of commodity prices and inflation expectations and know why cyclical commodities are where they are. This is our interpretation at any one moment in time. Are demand factors outstripping supply factors or vice versa? And if we have a particular cyclical commodity where demand factors are very clearly outstripping supply factors, then, of course, as traders and portfolio managers, we're going to find that very useful as a leading indicator. And if supply factors are outstripping demand factors at any one moment in time, then it's going to be difficult for us to use that commodity price as a leading indicator to potential future economic growth and stock market direction and returns. Now, we have, as I mentioned, a PDF in the download area. The name of that PDF is Cyclical Commodities Demand and Supply Factors. And in the download, what you'll notice is there's a whole bunch of sources and information relating to the oil, copper, lumber, and iron ore markets. So you can essentially, at any one moment in time, analyze those factors and gauge whether demand factors are outstripping supply factors for the commodity price move. So this is going to be a useful resource for you going forward. So when you see a cyclical commodity price move, you can use the resource and determine whether it's a demand-led move or a supply-led move. Now, obviously, earlier in this video, we looked at the CPI and the PPI, so the Consumer Price Index and the Producer Price Index. And we're looking here in a bit more detail now at the PPI All Commodities Index, and we're going to look at the contributory data behind this number. If you look at the screen, you'll see at the bottom of the page, you'll see a link that takes you from the Fred chart and the download data area on the Fred website for the PPI All Commodities Index. The link there takes you to the commodity groupings that make up the headline index, which is the index currently on the screen. And when you click on that link, you get taken to another page, and the page shows you all of the commodities contributory indices that contribute to the All Commodities Index. So you can see on the screen, on the left-hand side, you can see all commodities under the heading goods. So all commodities comes under this heading. And then underneath all commodities, you can see all of the various commodities that contribute under the heading of goods. So under the category of goods, and these create the index for all commodities. Now there's other categories, there's other commodity groupings. So that's on the left-hand side, as you can see on the screen. But on the right-hand side, we also have services and construction, and other commodity groupings and services and construction are not included in the overall all commodities number. The all commodities number comes under goods. But if you look at, for example, other commodity groupings, you can see that a lot of the commodities that are listed there, there's a big overlap with the contributory indices that contribute to the all commodities number. So because there's a big overlap, the all commodities number and the contributory data, because there's a big overlap, there's a very good representation of the other commodity groupings inside the index. What isn't represented is obviously services and construction. Although many of the commodities that we see on the left-hand side will be input prices to the construction industry. But let's recall from our previous analysis of the manufacturing and non-manufacturing sectors of the economy when we were analyzing ISM data. So if you recall, manufacturing makes up 20% of the US economy, and non-manufacturing, so services, makes up 80% of the economy. As traders and PMs, we don't have access to tradable commodities that we can sensibly use as leading indicators to all industries within the service sector and therefore the overall service sector. However, we do have access to cyclical commodities like oil, copper, lumber, and iron ore on a daily basis. So although we don't get a perfect representation of services, the services side of the economy, there's undeniably an overlap in certain areas. So services within certain service sector industries are linked very clearly to final demand, like cyclical commodities. There's an overlap in many areas. So for example, in real estate services, if there's, for example, a housing slowdown where we have lower building permits that are leading to fewer housing starts and housing completions, then naturally the demand for lumber will go down. If we're assuming a constant supply, so there's no supply issues in the lumber market, then the lumber price will fall, and real estate services, which are part of the service side of the economy, should slow down or contract. So if we see, for example, deflation or inflation in a certain commodity price and it's demand-led, if there's an overlap into the service sector, then of course this cyclical commodity price is potentially leading and overlapping many areas of the service sector. So it becomes obviously useful to us as traders and PMs. Additionally, we can always, of course, look at a particular service sector area and look at the industry index itself to gauge inflation and growth. So, for example, when you're looking at data sets and hunting around for data sets and index levels on the Fred website, you can look, for example, at a particular index, and here we've drilled down to the real estate services sector. And if you look on the left-hand side, at the bottom of the screenshot, you can see a link called Services, Real Estate Services Partial. And when you click on that, so when you're on the index page and looking at the chart, if you click on that link on the bottom, you'll be taken to a page that shows you all of the sub-indexes that make up the real estate services index. And you can see, for example, gross rents across the property sector. You can see non-residential property sales and leasing with land brokerage fees and commissions. You can also see management fees, and you can see residential property sales and rentals, brokerage fees and commissions, and also appraisal fees. So very obviously, if we're using lumber as one of our cyclical commodity prices that we're analyzing, if we get demand-led inflation or deflation, this can be a good leading indicator to a particular sector like real estate services. So services, we do not necessarily have or need the ability to be able to look at leading indicators that are directly leading into, for example, real estate commissions and brokerage fees. We know if there's a slowdown in the housing sector, in the construction sector, if lumber is falling, for example, and it's demand-led, so using it in conjunction with our other leading indicators, that this is likely to feed into the real estate services sector further down the line. So even though for goods, for all commodities, and the sub-indices for all commodities is essentially in the manufacturing sector, there is a very obvious read across to many services. One of the most useful things we can regularly do as traders or portfolio managers is to stay on top of cyclical commodity prices like energy and industrial metals and determine as a whole the general level of demand and use this as a guide to future expected inflation and GDP growth. We are using it as a leading indicator gauge. Now, if you look on the screen on the left-hand side, you will see the producer price indices for goods and in goods, all commodities. And then you'll see the sub-indices for all commodities, which are farm products, processed foods and feeds, and also industrial commodities. And within industrial commodities, you will see further sub-indices. So you'll see, for example, fuels and related products and power. You'll see lumber and wood products. You'll see metals and metal products. And also industrial commodities, less fuels. And what we can do is, if you look at the major subcategory, which is industrial commodities, we can actually, on the Fred website, click on industrial commodities and get taken to the page on the right-hand side, which is the Producer Price Index by Commodity, Industrial Commodities Index. So this essentially isolates our industrial cyclical commodities as a group, as a whole. And of course, we can always click in to the sub-indices like lumber and wood products, metals and metal products, fuels and related products and power, industrial commodities, less fuels. We can always click in to those sub-indices, bring up the pages and download the data and really drill down into the cyclical commodity indices themselves. But we look at the headline level, the all commodities index, and we look at industrial commodities index, which contributes to the all commodities index. So using these indices as a leading indicator gauge, when cyclical commodities are viewed as a group, their relative price performance may show healthy or weak demand from cyclical industries of the manufacturing sectors of the US economy. Now, prices may also go up or down based on supply side issues. We mentioned this earlier. If there is a constant demand and tightening supply, prices will go higher. That means we're getting inflation, okay? So we're getting inflation from a supply issue, a tightening supply issue. If there's constant demand, yet ever increasing supply, prices will go down. So we have the opposite. We have deflation from increases in supply given a constant level of demand. So if at any point in time we are analyzing cyclical commodity prices and indices, what we have to understand is that if when we do our work, we determine that the price is moving, whether that increases or decreases, if the price is moving because there's a supply-driven issue, we must temper our ability to gauge future economic growth. So basically, with supply-side driven inflation, cyclical commodities are going up in price, not because of an overall demand increase. And in that situation, real GDP may actually fall because demand is constant. And in this particular cyclical commodity, we have a supply situation occurring, okay? We have a supply issue that's causing the price to go up and demand is constant. So in the future, the read across into real GDP is a small read across. On the flip side, with supply side driven deflation, the cyclical commodity price is going down, not because of an overall demand decrease. It's going down because of an oversupply of the commodity given a constant level of demand. And even in that situation, when the commodity price goes down, real GDP in the future may rise more than we expect. So when we have supply side issues in a particular cyclical commodity, and we determine at any one time that this is probably the reason why a cyclical commodity is either going up in price, so inflation, or down in price, deflation, the read across, we have to understand that the read across in forecasting real GDP is going to be much weaker than if it was demand-led. If it's demand-led, then cyclical commodity prices are indicative of future CPI and PPI levels, which is reported monthly, so monthly inflation numbers, and of future economic growth, so real GDP growth, which is reported quarterly, so expansion and contraction. So if at any one moment in time, we determine that a cyclical commodity price move is much more down to demand factors than supply factors, then it has a direct read across to economic growth and, of course, inflation. And also, because we know cyclical commodities prices are trading every day, then they are leading inflation and GDP stats. This is essentially providing us as traders and PMs with another leading indicator gauge to the economy. So in the downloads area, you will see the spreadsheet called commodity prices, and you will see all the data for oil, copper, lumber, and iron ore. And you need to go through these spreadsheets and look at the commodities price data and look at the distribution of returns analysis. So the statistical distribution analysis for each one, and understand the 1, 2, and 3 standard deviation moves on a daily and weekly basis for each of the commodity prices, so each of the commodity products. And you need to combine this with the information and sources in the PDF document for the corresponding products for oil, copper, lumber, and iron ore, and learn about the supply and demand dynamics. You make a combination of these resources, and in the future, when you're analyzing commodity prices, you will understand what a normal move is and what an abnormal move is, and you will understand what's driving the price. Now, something else you can use as an indicator for future expected levels of inflation and growth is the commitment of traders' reports for the cyclical commodities that we're looking at. So let's have a look at what we call the commitment of traders' reports, or COT reports. We can use non-commercial transactions data from the Commodity Futures Trading Commission, the CFTC, as an indicator for professional money manager positioning in our cyclical commodities. So what this data actually is the real positions, long and short, of the smart money in the market. It's the institutional and hedge fund money. So when we analyze this, what are we getting? We are getting a sentiment gauge of future expectations of inflation and GDP growth from their positioning in cyclical commodities. So we analyze this data regularly to get a sense of how the smart money is positioning itself in the market. And this data can act again as a leading gauge of future expected inflation, GDP growth, and general stock market direction Specifically, what we want to know is if the smart money are long or short a particular cyclical commodity and by what magnitude. Now, these numbers have not fallen from the magic fairy tree or fallen from the sky. They are real numbers. These are the real positions, long and short, of institutional and hedge fund money. Okay? They are real numbers. Of course, if hedge funds are positioned long, they are committed to the belief that the commodity will go up in price. Therefore, they are committed to cyclical commodity inflation and, of course, vice versa. This is why it is called a commitment of traders report. And by the way, when you look at this data, what you also have to understand is that the hedge fund community have been through the same leading indicator analysis as you have throughout the PTM video series. They are looking at the same things. So the COT report data is useful because we can calculate turning points in positioning in professional trader circles in the hedge fund community. Therefore, we are determining professional trader or hedge fund sentiment and their inflation and potential growth expectations because of the positioning that they currently have or changing in a particular cyclical commodity. Now, how do we actually go through this data and determine inflation and growth sentiment from the hedge fund community? Well, in the downloads area, you'll see the commitment of traders spreadsheet file, and we cover the cyclical commodities space. We've got all of our cyclical commodities in there, and you'll see the numbers for each of the cyclical commodities on the screen here. We've looked at copper as an example, and you'll see the four columns that we're looking at. We're looking at total open interest, we're looking at manager longs, manager shorts, and we're looking at the net long and short. So what do? We do our analysis by taking the open interest percentage change on both long and short non-commercial hedge fund positioning and work out the difference between the two. If we minus the percentage short positioning from the percentage long positioning, we get the difference between the percentage of contracts that hedge funds are long and short, which gives us the net. And what this does is create a new dynamic that is known in professional trading circles as the flip. The flip basically shows us when hedge funds flip from committing to being net long to net short or net short to net long. And it also shows us how committed is the commitment. So the rate of change by which positioning is changing. Now, if you look at the screen here, as mentioned, we are using here copper as an example, and you can see our four columns, and you can see on the screenshot that we've taken this directly from the data in the spreadsheet download, and we're looking at the period April 2020 to August 2020, and you can see we've highlighted 2 weeks in the data, which is the week of the 26th of May and the week of the 2nd of June. And you can see on the right-hand side in the fourth column, you can see the flip occurring at this stage. So the flip occurs in the week of the 2nd of June, 2020. What this means is that the net positioning of the hedge fund community in copper has gone from being net short to net long. So they've gone from being, as the professional trading community, going from bearish to bullish. So right there in that week, you can see the flip occurring. Now we can actually chart the commitment of traders data for the entire history. And that's available in the download as well in the spreadsheet file. You can have a look at this in the spreadsheet, and obviously also look at the data in all the columns that's feeding this chart. And you can see on the screen where the red arrow is pointing, this is where the flip in copper occurred in the week preceding June 2nd, 2020, because the report is on the data for the previous week. So if you think about this chart in its entirety and think about periods that we've looked at previously in the PTM video series, think about the August 18 to August 19 period, and think about the period when the Fed was cutting rates over the summer of 2019, and then the lead out of the turnaround in the economy in the second half of 2019. So think about that period. You can see on the commitment of traders numbers, when we look at 2018, we get a peak, and then the hedge fund community is getting less long in copper, so they are less committed. They are committed long, but less committed. And then we get a flip going negative during that August 18 to August 19 period. We bounce around at the 0% bound for a number of months. And then in the spring, summer of 2019, that's when bearish sentiment or net short positioning in the commitment of traders reports for copper accelerates and goes lower to a trough. And then we get a trough coming out of that trough when it seems the Fed's actions began working, and the commitment of hedge fund traders, the hedge fund community, gets less short. So they're still committed short, but get less committed. And then we get the flip that we just looked at, where we get a flip positive in 2020 after COVID. We did get a flip before where the hedge fund community did go positive at the end of 2019, beginning of 2020. But COVID was obviously taking hold in the first quarter of 2020. And then we get the flip positive long back in June 2020. And we see this data borne out in prices as well. So we can look at the copper price and what was going on at these times visually on the chart. So if we look at our cyclical commodity copper price during that period, mid-2018 to the end of 2019, you can see the copper price heading lower as the commitment of traders, the hedge fund community, gets less and less long and then flip to short and get bearish. And then we have our recovery where we know during that period in 2019 where we had the Fed cutting rates in July, September, October 2019, we know they started to take effect. The interest rate cuts started to take effect. Our leading indicators were turning around. And then we have COVID. And then COVID occurs, but then we get our flip aggressively in the copper price from the hedge fund community at the beginning of June. So end of May, beginning of June 2020. So at any one point in time, guys, for cyclical commodities, you need to be looking at the commitment of traders' reports and analyzing the flip. The flip is where we tend to have turning points in cyclical commodities, but you also need to look at the extremes. So when the gap between positive and negative sentiment becomes historically wide either way. So we're looking at the peaks and the troughs in commitment of traders' reports for cyclical commodities. So when we have extreme positive, it basically means that longs versus shorts are at or near historical highs. When we have extreme negative, it's because the longs and shorts, longs minus shorts, are at or near historical lows. So when we witness these extremities in cyclical commodities, it can be a signal or a warning sign of potential turning points. However, guys, there is obviously no rule book here. Positioning and prices of a cyclical commodity can stay at extreme positive or extreme negative for a long time before reversing. So don't take this as a rules-based scenario where, for example, you're trying to connect things in your mind where you say, if I see, for example, the copper commitment of traders peaking, then I should be looking to short copper stocks. That's not the case, because the definition here of the positive data from the longs minus the shorts being at extremes and becoming slightly less extreme is simply the hedge fund community are still bullish. They're just less committed than before. So it's a fallacy to read into this and say, at, for example, a turning point from a peak or a trough, I should directly read across into the stock market and say, I'm going to go short or long, for example, copper stocks or construction stocks from lumber. It's obviously doesn't work like that, guys. It's not a rule book where you take positions simply based on the flip or the extremities becoming slightly less extreme in the commitments of traders' reports and directly reading across into positions in stocks. So definitely do not do that. You have to do the proper work, which is looking at the actual demand and supply dynamics as well, to see if this is the demand-led or supply-led in terms of price movement. What you're doing with the cyclical commodities commitment of traders' reports is looking at sentiment and looking at it in the context of your work on the demand and supply dynamics. And if you're seeing evidence that a commodity price move, a cyclical commodity price move, if you're seeing evidence that it is demand-led and you're seeing evidence from the hedge fund community that they are seeing it too and they are getting committed one way or the other, then what does that mean? Well, it basically means that your cyclical commodity that you're using can be used as a leading indicator for future economic growth and potential stock market direction and returns. Now, something else we can look at is the US dollar trade weighted indices, or TWI. All major commodity benchmarks are priced in US dollars. If we get a fall in the US dollar, this is generally inflationary, so prices going up for our cyclical commodities. And when the US dollar is rising, this is generally deflationary, so prices going down for our cyclical commodities. As traders or PMs, we have to keep an eye on the US dollar versus a basket or baskets of rest of world currencies as an indicator for expected CPI and PPI inflation in the future. So if the US dollar weakens or strengthens, we are likely to get higher or lower commodity prices. And remember, turning points and trends in commodity prices must be backed by demand evidence and data So commodity prices moving in the inverse direction to the US dollar move, and inventory levels rising or falling. Now there's three trade-weighted US dollar indices that we look at, and they're available in the trade-weighted spreadsheet file in the downloads area. And don't worry, all of the links are in there as well. Our three indices that we look at are three trade-weighted US dollar indices. Are firstly, the Broad Index for Goods and Services. Secondly, the Advanced Foreign Economies for Goods and Services. And third, the US dollar index for emerging markets economies for goods and services. And if you click through the links, for example, to the Broad Index, you can see the weightings of all of the currencies of the US's trading partners that are used. So you can see the weightings of the currencies that make up the index. That's for the Broad Index. For the Advanced Foreign Economies and the Emerging Markets Economies Index, you can get the weights if you follow the links to revisions to the Federal Reserve dollar indices. But you can use these as a guide for AFE and for EME as well. And for example, like with our other indices that we've looked at, and we've done this many times now, and you'll have seen this in other spreadsheets, you can go to the FRED website, have a look at, for example, the Broad Index, and you can download the data. And yes, you've guessed it, you can run a statistical distribution analysis, a distribution of returns on the trade-weighted US dollar indices. On the page here, we have the Broad Index, and you can analyze, we've done the work for you here. You can analyze, for example, 2 and 3 standard deviation moves, both on a daily basis, so using daily data, and on a weekly basis, using weekly data. So daily data is on the left here, and weekly data is on the right. We can do that as well for the AFE index, so the Advanced Foreign Economies Index. Have a look at our standard deviation moves for daily and weekly data. And we can do that for the emerging markets economies as well. So the US dollar index, EME index, and we look at the 1, 2, and 3 standard deviation moves to determine for each of these indices what is a normal move on a daily basis and on a weekly basis, and what is an abnormal move on a daily and weekly basis. And we look to this for trends and turning points. So in the future, when you're looking at the data, so daily and weekly changes of the trade-weighted indices, and you see what could be an abnormal move when compared to historical data, you will know that we are probably experiencing a change in macroeconomic conditions and potentially inflation expectations and GDP growth expectations for the United States. What we've also done for you, and I mentioned this previously in the downloads area, is we've included a summary file. Now, the summary file for all of our cyclical commodities and for the US dollar trade-weighted indices calculates beautifully all in one screen for daily and weekly data, the 1, 2, and 3 standard deviation moves in the negatives and the positives for all of our products. So this is data that you're going to be updating when new data comes out, and you'll be doing this on a regular basis. And when you look at the price data of cyclical commodities, and when you're putting it into the context of demand and supply dynamics, looking for demand-led price moves, and when you're looking at it in the context of the commitment of traders' reports and the trade-weighted indices, you're going to have a very clear picture of what's going on. and using the cyclical commodities prices in themselves as leading indicators. So, in summary, cyclical commodities prices. As traders and PMs, we have access to them. We have access to several cyclical commodities prices that can act as leading indicator gauges to levels of future inflation, real GDP growth, and stock market direction and possible returns. We have to keep on top of them, guys. We have to keep on top of the most common cyclical commodities prices in both the energy and industrial metals spaces. So in the oil market, copper, iron ore, and in addition, lumber in the construction market, we have to be on top of them, and we have to gauge demand, supply, and inventory dynamics. Also, when we're analyzing prices, we need to look, when we're looking at cyclical commodities prices, to normal and abnormal moves as clues for turning points and trends of inflation and growth expectations. We have to keep on top of the commitment of traders' reports of the cyclical commodities in order to gauge what the smart money sentiment of inflation and growth expectations is at any one moment in time in the market. And we also regularly have to keep an eye on the US dollar trade-weighted indices for normal and abnormal moves for turning points and trends. And of course, even though they are coincident indicators, we will also be on top of monthly inflation numbers. We will be on top of CPI and PPI, and we will know what normal and abnormal moves are that show up in the later monthly releases. So, taken together with our other leading indicators, understanding and being on top of both normal and abnormal moves in our cyclical commodity prices and the US dollar trade-weighted indices, plus also knowing market sentiment from the COT reports, gives us an additional leading edge and gauge to predict future inflation, GDP growth, stock market direction, and potential returns. These are useful indicators, but we have to understand the context that we have to view them in. As long as we know that, they are useful indicators going forward at any one moment in time that we can add to our leading indicator list.
Okay, so in video 11, we covered the NFIB SBO index and why it's useful. And then we made a jump. We jumped from surveys in the United States to analyzing cyclical commodity prices. So why did we go and do this? Well, there's two main reasons. Firstly, at this stage, after we've covered money markets and surveys in the United States, it's the right time in terms of your educational development and progression to get an understanding of inflation and supply side factors. Inflation is downstream from both demand and supply, but supply side factors can affect leading indicators, especially in the manufacturing sectors. So commodity prices and understanding them, so cyclical commodity prices, understanding them, it gives us a gauge on future levels of inflation and therefore real GDP. So gross domestic product adjusted for inflation. So it also not only gives us that, it gives us, obviously, if we understand real GDP growth direction, we get a better understanding of stock market direction, and we also get a better read for our portfolio bias. We just have a general, overall, better understanding of what's going on in the economy. Secondly, cyclical commodities are not just quoted in US dollars and tradable in the United States. They are also traded in other geographies around the world, and they're denominated in those geographies in different currencies. So we will be moving on to international surveys next. So at this juncture, again, in terms of your educational development and progression, covering cyclical commodities is the right thing to do here. Now, in the downloads area, there are multiple spreadsheets for analyzing cyclical commodity price data, but also there's a PDF which outlines all of the supply side factors to take into consideration when analyzing the data. So that's really there for you to determine at any one time whether a move is demand-led or supply-led. So bring yourself up to speed with all of those resources and watch the video over again if you need to. Okay, so we're going to move on now to international surveys. So we're going to be looking at leading indicator surveys in both Europe and China. So in video 13, we'll be looking at Europe, and in video 14, we'll be looking at China. So let's shoot over straight away to video 13. Let's get straight into it, and I'll see you at the end of the video back at the desk.